Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant. I'm the host of the Smart Property Investment Show. I hope you're well. Enjoying your time. Maybe you've already started your holidays. That's what everyone's talking about right now. How long has everyone taken off? I think the typical cadence for most professionals is that they're at least taken off until the 8th of January, but I know a lot of people will actually use that time over January to take more time off, spend time with family, get all those projects done that you've been thinking about doing for all year. I'm certainly in that boat, but a lot of people will be thinking about their property portfolio as well. So it's a good time. It's a good time to reset, recalibrate, prepare and plan for the future. Heaps of info on smartpropertyinvestment.com.au to help shape your thinking, your mindset around that. I've been having some really good conversation lately around some innovation in mortgage financing, and I've said that one of the triggers for determining or dictating how property markets will move into the future is access to capital. So this idea of how easily investors can access debt, and you're already seeing refinancing buffers coming down 1% from some of the major banks, both at a refinancing level, but some people I know now are able to secure new financing investors with 1% buffer rather than the 3% on top of it. And this is a really important aspect of how mortgages will operate moving forward. Interestingly for me, as I sort of navigate my property portfolio, and by the way, I've done a fair bit of recording on this. You've got to be squeaky clean if you want to be getting these sort of these reduced buffers in front of your mortgages, but surrounding yourself with the right people to ensure that you're making the right decisions. And I've been a huge advocate of building the A team of people around you. I speak a lot about it on this show, and it's something that you need to be if you're serious about property investing, is making sure you've got the right people giving you the right advice. So that might be something you do over the Chrissy break, is thinking about it. There's some very good people out there. And there's some very good associations out there as well. I think about the Property Investment Professionals of Australia, which is a really good place to start if you're looking for the right people to help you on your investing journey. Do they have a PIPA endorsement? Maybe they do, maybe they don't. It's a nice place to start. That's for you to work out moving forward. Someone that does a connectivity with PIPA that I know quite well is Lachlan Vidler. He's comes on our show quite often. He's actually on the board of PIPA. He's from Atlas. Buyers agency, and he's doing a lot of stuff in the tech space as well. So I've asked him back onto the show to see where he's up to and what he's up to and what's he doing and what 2023 was for him. A bit of a recap, but importantly, what 2024 looks like. Lachlan, how you going?
Good morning, Phil. I'm good. How are you?
All right. What's been happening?
Just busy. I feel like it's a standard answer, isn't it? You know, how long do you have? That's what's been going on. It's been great. I think we're in here only a couple of months ago, and I think it's just been such a busy period for us. Obviously, lots of property buying. We've got, I've got separate to Atlas Property Group, the tech platform that I announced last time I was on the show.
We spoke about that.
We did. Yep.
All right. Give me an update on that. I'd like to know what's happening. But before we do that, mate, sort of sniffing around and watching your business grow. I saw you on, I think it was some sort of Facebook post or a LinkedIn post, Buyers Agency Champion at the Australian Small Business Awards.
Yeah.
That was a month or so ago, was it?
Oh, that one was earlier this year.
Yeah,
no, the one that we had, the one that you probably would have seen was our finalist in the REB Awards for 2024.
That's right, for Buyers Agent of the Year.
Yeah.
So that's you as an individual,
Yeah, that's me as an individual, yep. So we've been up for the last 3 years for that award, as well as some other ones. The earlier this year we were 2023.
You're finalists for Thought Leader.
Thought Leader, yeah, exactly right.
Is that because of the great thought leading that you're doing on this particular podcast?
You know me, I love a bit of thought leading. I think it was a few things. I think it was obviously wrote and published a book. That's right. On property investing. That was a bestseller. And then also the work I do through PIPA. I also teach at the University of New South Wales.
That's right.
So, I'm a big believer in the education side, and I guess that really plays into that thought leader aspect. Unfortunately, didn't get the win, but you got to be in it to win it, right?
You got to be in it to win it. I've gone in for a lot of awards over the years as I was building this business. They're good to do because you might not. Being a finalist is pretty cool, and good luck with the 2024 iteration of the REB Awards. But just doing the work is key, right? Like, you learn a lot trying to articulate, and this for those professionals out there sort of going into awards programs, you get a lot of win, lose, finalists, it's largely indifferent. If you go through the work of lodging submissions as a business building exercise, it's really, really key. You'll think critically about your organisation, and when you've got to try and articulate what you do in a 300 words, whatever it is, it can get pretty tough, mate. So I hope I'll be there on a night. The thing is that I've got, because I know everyone in real estate, people always go, Phil, and because I know everyone in real estate, because most of the people who go into all these programs, everyone's like, oh yeah, and I go like, well, I got no idea, like, it's a broad church. I'm like, I'm here to help support and champion the industry, much like Pippa and other people as well. But how's Atlas gone? You guys been hitting it? You've been finding good properties?
Absolutely. I mean, I think, well, you said before, so we were the 2023 Buyers Agency National Champion, the Australian Small Business Awards. That was earlier this year, and that was crazy. Like, that was out of 40 other people who were up for the awards. So it was amazing to come away with that. And it was great for the team to see their hard work recognised. But I think what really was key for getting that win, which is what we're seeing for the rest of this year, is we have had some crazy performance, right? So we take our performance really seriously. Like, for us, it's not just about buying property, right? Atlas Property Group it's investment only. So the way that I look at it is...
You don't do owner-occupied?
No, we don't do owner-occupied.
If someone goes again, no, don't touch it.
No.
Okay.
So because of that, it is all about performance, because if someone's coming to work with us, they're coming to work with us because they think that we're going to be able to do it better than them. And of course, we believe that. But we've got to have something to hang our hat on, right? We've got to have something to be able to point to that. So, like, here, I'll give you some numbers, because like I said, we run our performance stats every year. We go get bank vals on every property we've ever bought to do that, so that way we're getting accuracy, not just the local real estate agent who maybe wants to, carry a bit of favour. Yeah, exactly right. So,
so just on that base, before you give the numbers, so what we're talking about there is a bank val versus a real estate agent's valuation.
Exactly right.
Often, the real estate agent's valuation will be a little bit higher than a bank val.
Exactly right.
But I have had it the other way, where bank vals are very different to that. Like, recently, I've sold a couple of properties where the bank val was, I can think of one property, bank val was $1.6 million. We sold it for like $1.43 million.
Yeah, right.
And that was the top end of the agent's assessment of it all. So sometimes it swings the other way. But
absolutely.
So you base your numbers off bank vals.
Yeah, and I think at the end of the day, it's like, well, if the bank is going to give us that val, that means the bank is willing to loan us money against that val. And as far as I'm concerned, that's the gold standard. Other than selling, that's the gold standard that you can get in terms of understanding the value of a property, because the real estate agent, they just write whatever they want, right? Especially as another business, maybe they want to make themselves look better to us or do something like that. So for me, I go, well, maybe that's true, maybe it's not. But if the bank is going to go, hey, we'll give you money based on this, to me, that's a pretty good indication of this is a fair,
at least it's sort
value.
of like for like. So,
exactly right. Yeah.
Yeah. So does it cost a lot of money to get all these bank vals?
Or for us, it's something that we're willing to wear in the process, because it's it's all about that performance, right? And it allows us the time and the effort to go through organising all these vals. It allows us to not only give our clients good news, but it also allows us to then say to other people who do come to work with us and go, hey, we know most people out there don't even track it, right? You become a number, they buy for you, you're done after that, right?
Yeah.
We actually go, hey, we're showing you, we're showing you exactly what's going on. You obviously don't get to see behind the curtain of all that, but if anybody ever called into question some of our numbers, we've got every single bit of paper sitting there going, this is what it is. We've got our proof.
And this is on the assumption that a bank's not going to overlend on a property's value, because it's called a security for a reason. That is, if everything goes wrong, they've got to sell that thing, and they want to make sure they sell it for probably more than the the debt as a percentage of its total value is connected with it. So
exactly
that's
right.
why bank val is important. That's why a lot of people are going, when they're buying stuff, did the val stack up? Did the val stack up? So you buy a place for $1 million, the bank says, no, Mr. Tarrant, this is only worth $900,000 and I'll lend you 80% on $900,000. And they'll go, I got a shortfall of $100,000. This is a big problem, right?
Yep.
So anyway, it does happen. So what were the numbers then for you?
So the way that we do it, and we did the same thing last year. So people go and listen to our episode last year. We did the same thing, and I guess again that goes to show exactly how seriously we take this. So the way that we do it is we get the vals on all of our properties done. We then compare it to the performance of that suburb, with the idea being if you had have known that suburb, which is already our own research, but we'll put that to the side. If you had have known that suburb's a place to be, and you threw a dart at the board, this is what buying the arbitrary property in that suburb is going to do, right? And to me, that's the best benchmark we can get. It's better than looking at the national average. It's better than looking at, or national median. It's better than looking at state medians, because at least you now drill down into one location with, maybe a couple hundred or a couple thousand homes, right? So the numbers that we had is lifetime, which I think is pretty cool. So we go back and we evaluate every property ever bought. Lifetime, we're running at a 19.9% annualized capital growth rate. So that's on properties that were bought, 3-4 years ago that have obviously gone up, and now they might have plateaued because that market's no longer moving. There's probably some markets as well where they went up and they dipped back a little bit after that, big COVID push. So to be running at a 19.9% annualized rate lifetime, I think is pretty crazy. And the suburbs over that same period, 13.4. So that meant we've outperformed by about 6.5% on average that whole period, right? And considering the lifetime, the RBA did a study a few years ago on long-term capital growth in Australia, and they said properties on average tend to grow at about 7.25%. That means we've almost outperformed by a whole year's worth of growth just in one hit.
So that's what the RBA reckons is typically about 7.25%.
Yeah, 7.25%.
Average annualized growth.
And that was over a
30-year
time series study that they conducted.
So when you think about that, so you're getting 7%, 7.25% a year is largely what you can assume your property is going to perform at over the long-term period.
Exactly
It's
right.
not the immediacy. So what you're talking about often know is the immediacy of uplift over a period of time, shorter, and on the basis that people think, well, I'll use buyer's agents to try and secure properties that are going to grow faster outside of the traditional. You want to beat 7.25%. You've thrown your money largely anywhere in Australia. There's some places where I wouldn't be putting your dough and you're not going to be getting that sort of thing.
Yeah.
So you could assume 7.25%. And a lot of people right now, Lachlan, will be getting their calculator out or some sort of compounding capital growth calculator and putting in, this is my value of my property today, growing at 7.25% over 10 years. And they're going to get a number and they're going to say, there's no way in the world that property is going to be worth that much money in 10 years' time.
Yep. And then
I do it all the time. And I go, no way.
Yeah.
No way. But it sort of does, right?
I mean,
if you buy in the right spot.
If you go back to the early 90s, the median price in Sydney was just under 300,000.
Yeah.
It was like 280 or something. The median price in where's the other one that jumps to the top of my head? I think it was Brisbane was like 180 to 220 or something. And you look at them all now, right? Like nobody in the 90s would have said the median price in Sydney's, seems to fluctuate every other day at the moment, but over $1 million. No one ever would have thought that. And look at where we are.
Okay, so
that's lifetime. Yeah,
lifetime. So what you're saying is that you're outperforming
absolutely
the market.
Yeah, but then if we bring it shorter term as well, so the beauty of what we do is we can look over long periods, we can look over short periods, we can do all that. So we then we then looked at what happened last financial year, right? So last July to this June, so FY23. How do we go in FY23, right? Because that was a year that, at least according to the more mainstream media, it was a bad time to buy property and all that. Over that period, so all the properties that we specifically bought last July to this June, we had an average annualized capital growth rate of 22.8%.
Okay.
Meanwhile, the suburbs that we bought within, again, so giving us our benchmark, did 6.4. So that meant we outperformed by about 16%, right? So that was pretty good. And the national market went down by 3.4. So by a lot of different metrics, we did a fantastic job for our clients.
So how are you outperforming the suburb where you're buying?
That's the secret sauce, Phil. How can you ask?
Well, I see that going, but like you're going, well, this is how the suburb performed, but the properties that you bought inside of that suburb grew at a different rate.
Yeah.
Like how?
Well, to me, I think it comes down to a few things, right? I think we have extremely robust due diligence process, which means, and I know a lot of people say that, we see 100 properties and only buy one or two of them, but the numbers speak for themselves that we have to have a very robust due diligence process to be able to know that sort of performance, right? Because you just wouldn't be able to get it. That's why we kill deals left, right, and center when there's any aspect of it that we don't like, right? Or sorry, probably more importantly, any aspect of the deal we don't love, we kill, right? The next part is because of my background, and we were sort of saying it before, right? Having the educational background I do, like having masters in sort of the finance and property sphere, what I think that's allowed myself to do, and then by extension through my team, is our level of knowledge is a lot higher than the average person, right? So our ability to analyze, our ability to forecast, our ability to break down and analyze and all that, it's just a lot higher than somebody who doesn't have that same set of skills. So it allows us to then see things that other people might not. And the analogy I always give when clients ask us that is, how is it then that two doctors who have done the same medical degree, one can be better than the other? At some point, it just comes down to who can just see things better. Who's got that same level of, you've got the same papers, you've got the same background, but sometimes it's the same as an athlete, right? Michael Jordan, right? Everyone should know who Michael Jordan is, basketball player, right? At the end of the day, all he did was he moved a ball up and down a court and shot it into a hoop. But not many people can shoot like Jordan, right? So at the end of the day, at one point or another, it comes down to who can execute better with the same information. And I think that's what we do far better than anyone else. And that's why we've got the numbers to back it as well, which I think is most important.
Okay. Well, thanks for sharing that. And I'm sure anyone, they're more curious about that, they can give you a call or drop you a line, or what's your website?
atlaspropertygroup.com.au.
Okay. All right. So if you want more info on that. Now, tell me about Talvr. What's going on? You unveiled this last time we got together.
Yeah. So Talvr's been going fantastic.
Talvr. I call it Traveller.
No,
Talvr.
that's all right, mate.
Traveller. I don't know where it comes on. Talvr. Talvr.
Yeah. So very tech name, right? Talvr. So as I announced, to everyone in the episode a couple of months ago, so we just launched Talvr. It's actually one of the world's first integrated property performance management platforms, with the whole idea being get everybody out of Excel, because a lot of people don't know how to use it properly. A lot of people don't have the time, and it doesn't look very pleasing either. So you jump onto Talvr, you input your property portfolio information, what you bought it for, that type of stuff. And then through the platform, you can actually manage the performance of your property, right? So you can track capital growth, expenses. We've got a great partnership with Domain Price Finder, so you get a valuation every month. You can track the cash flow. You can export tax reports. You've got calculators. So when you were making the comment before about people trying to work out what's their capital growth rate, you can do all that through Talvr. And then we're actually very shortly going to be releasing the business side of our platform. So your advisors are going to be able to jump on, and you can have your buyer's agent managing your portfolio via the platform. So we announced that a couple months ago when we jumped on board. The response was incredible. So in less than 2 months, we've had over 1,000 properties added to the platform. We've got, probably now almost approaching 1,000 users on the platform as well. So it has been absolutely incredible, and it has allowed us to, get some amazing feedback, keep innovating and keep updating. And by all accounts, everybody has been telling us, thank God we're out of Excel.
Yeah. Well, Excel can be a headache if you don't know how to use it. I'm weird with Excel. My Excel spreadsheets are perfect. And when I see an Excel spreadsheet that's not, I go, well, if your attention to detail on your formatting is wrong, typically the numbers inside it aren't. So, and I'm conscious that a lot of people aren't that skilled in Excel and being able to sort of create their own thing. So it's good that you've made something. So it's free?
It's
how does it work?
So right now, where it's free to use for everyone. So jump on board and make sure you take advantage of that. So you can just jump onto Talvr, talvr.com or .com.au. We have both domains. So however you type it, But yeah. So for now, it is free to use. But obviously, as we continue adding features and things like that, we'll then obviously revisit the business model behind it. But it's just been incredible. And then just having people, sending us emails and just talking about how, they've really struggled. Like the big driver behind it was actually financial literacy. So in Australia, 86% of people are rated as having low or average levels of financial literacy.
According to
a study done, it was actually a global study. Okay. So there's numbers. So we're not too dissimilar to the rest of the world, which is why we really wanted to start Talvr, my co-founder and I. But because of that, and then, you look at the amount, like 47% of properties in Australia make a net rental loss, and I think a lot of that comes down to people not having the literacy, the financial literacy to understand the performance of their properties, how it's going. I have clients who come to me through the Atlas channel who say, I bought a property 10 years ago and I didn't know that it was performing as badly as it was because I just didn't know how to look at it.
Yeah.
So that was actually why we started Talvr, was that financial literacy piece to help people go, let's take better control of your portfolios, which in turn should lead to better retirement outcomes.
This goes to my earlier point around surrounding yourself with the right people.
Yeah.
And a lot of property investors will have an accountant. Most will have. I know some property investors, they still try and do their own tax. Mad. But they'll have an accountant. But not all accountants are created equal, just like not all doctors are created equal, not all basketball players are created equal. Some accountants are very good at property investment. Other accountants aren't so good at property investment, and they sort of don't really get it. They don't understand it. And when they don't really understand and appreciate how their property is performing because they outsource or they assume they outsource that to an accountant, the accountant might not actually know how to look at the performance of a property investor if they're not a property person. So it sounds as though you've been able to sort of solve that some way by presenting the information people need to know so they can make more informed decisions, right? Yeah. This is the important thing.
And I think it's a really good point that you're making, because I would say that's not just exclusively with accountants. Like mortgage brokers, the same. Honestly, some buyer's agents out there, you got financial advisors or financial planners, the same. So that was, again, a lot of the intent behind that financial literacy piece of starting Talvr was because we needed to make it really intuitive, really attractive, really visually appealing. So, your mum and dad investors, you can just jump on and see it. But then your advisors, and that's that part that I mentioned we're going to be launching imminently, your advisors can come on. So that way you can have a really informed conversation with your advisors. That when they say, there's a big problem with some of with some businesses, like in the buyer's agency space, just as one example, but I know it goes across a lot of others, is some people might say to clients, we're always looking out, we're always watching. Obviously, we do because we track our performance stats. But when you don't see it, it can be, you might just think, we're just a number, we're off to the side. So that idea behind Talvr for Business means you can then link in that accountant, that buyer's agent, whatever, and that they are looking at your portfolio because you can see them. You can see them in there, you can communicate with them, you can call them up and go, did you just see that valuation I got on the property? Like, how good's that? Or, hey, I just upped my rent, or this or that. And it makes that ecosystem so much stronger, and ultimately, ideally, it is going to allow people to have better results.
And I can tell you from experience, it gets a lot harder. I don't know how big your property portfolio is at the moment, but the more properties you get, the harder it gets in terms of administration. I think about now, you're talking about raising rents. My a couple of properties I've got up in Brizzy, it must have been the third or fourth time the agents contacted me saying, your lease is up in 60 days' time. Now it's 48 days' time, so I've missed the boat. We need to increase your rents. And I look at it and go, I got to sort that out, but I ain't got time. I need to go and look myself to see what it should be so I can go do it at this rate. But, your administration is key. So if you lack some of that sophistication, you should be trying to find those tools that you can to support you. Now, Lachlan, let's chat about property, because we've been chatting about your businesses.
Everything else.
So, let's put that aside. It's good that things seem to be going good, mate. Congratulations.
Thank you.
Best of luck with the REB Awards, which is on in February.
It's a couple of months away.
And for our listeners out there, don't know that's a Real Estate Business Awards. It's a big universal awards program for real estate in Australia. So real estate is quite fragmented in Australia. You've got state-based bodies like the Real Estate Institute of New South Wales. Then you have national bodies, the Real Estate Institute of Australia. Pretty fragmented. They don't often or always like each other. It's sometimes they're friends, sometimes they're not so. So it's hard to get an aggregate whole of nation level. Real estate's sort of fractured also in that you have sort of franchise-based operators like McGrath or Ray White, and then you have independents. So no real universal connectivity other than REB. So if you see one of your advisors or one of the guys that you work with part of that REB awards program, that is a universal recognition of it, rather than it sort of being some sort of bias or agenda to a particular franchise group or a particular state-based body. So look out for it. Welcome back, Phil Tarrant from Smart Property Investment, chatting with Lachlan Vidler from Atlas. Now, how would you explain? How would you identify? How would you describe the Australian property market as of December 2023? Discuss.
Oh.
There you go. You're a lecturer or something or other, right?
It should be easy.
It should be easy. Talk, in less than a minute.
Oh, in less than a minute.
You've got a minute to tell me the state of play in the Australian property market today.
Well, I'd say
not looking forward today.
Yeah, I'd say in terms of today, we have to look a little bit back, and I'd say 23 has been a year of two halves. Okay, the first half of the year, we obviously we're in that middle period of all the interest rate increases, and I think for a lot of for a lot of people, sentiment was just down. Nobody likes to see rates going up, and for a lot of people, it has started to bite. But realistically, there was a lot of room that people had right before it would really start to impact their budget. But sentiment got really, really challenging. The second half of the year, though, was really interesting to see because we had that pause, right? We had that pause. I think it was either 3 or 4 meetings from the RBA where they didn't move the cash rate. And it was crazy from a business point of view, seeing sentiment just got better and better, and people got more confident and more confident, to the point that we were at sort of now where the increase last month, I think it cut people a little bit. Not necessarily the
took the wind out of their sails.
Exactly right. Yeah. So, but then seeing the hold in this month, in December, I think that sort of made people go, okay, it's all right. Don't worry too much. We're coming into Christmas. The numbers that came out that drove that increase in November, that then also drove the pause again in December, are starting to look a lot better. So I've noticed a big sentiment shift. But to describe sort of where we're at, fluid. Fluid would be how I'd probably sum it up.
And fluid's okay, depending whether you're a glass half full or glass half empty. So let's talk about 2024 then, and probably 4 major factors which impact property. I'd say, migration, this sort of inflation, interest rate process, supply, and sentiment. You spoke about sentiment. We spoke very briefly on my views towards access to mortgages, and I say that's probably bundled up in interest rate. Is starting access to be able to refinance and or secure new debt. It's starting to get slight. There's these green shoots of recovery there. But let's chat about migration. And we saw only middle of December, the federal government has come out saying they're going to shake up immigration. I think it's like 500,000 people the last 12 months have come into Australia. And again, this isn't a political podcast, but the government's response, it would appear, towards this housing affordability crisis is to stop or curtail migration rather than solving the issue of structurally fixing the housing affordability crisis, which means we don't have enough houses. So let's stop. Let's stop the one part of the economy which is actually keeping us out of a recession. That is, we would be in a recession if we didn't have the levels of migration that we've had. So anyway, let's get a bit political, but that's their response to it. What's going to happen with migration, your view, your read on it? Is it really going to make that much of an impact if they shape migration moving forward? And it just sounds as though they're going to clamp down on temporary student workers, which is inverted commas, these visa factories, right? Which they're calling it a rort and they're calling it dodgy stuff. And what they're talking about there is there's a lot of colleges in inverted commas in Australia, which provide visas for people to come out to Australia, and essentially it's just hearsay, a rort for getting workers who they pay under minimum wages too. So this is what they're trying to clamp down on. So is that really going to make much of an impact? Maybe on rents.
Yeah. Well, I was going to say, I'm so glad that you brought out, because that was the first thing I was waiting to get out of my mouth. The people that they're actually going to be impacting the most of are the students. So they're estimating that this year we've had about 510,000 people net migration, right? So obviously more people arrived, some people left, and then we come up with 510,000 is about the net overall result. By changing the migration, it was great headlines, right? It was great headlines going, oh, we're going to curb this, we're going to curb that. But from a property market point of view, I don't think it's going to make much of a difference for a few reasons. Firstly, there's some people out there, want to do rooming houses and that sort of thing. But for me, I'm probably not wanting a tenant that's 3 students, So that's not really impacting the demand of my properties or any of my clients' properties or probably any, really savvy investor. It's not going to happen. And then you also think about where are these people living? Well, they're probably in these big student-driven areas very close to the universities, which can be good places to invest. But if you're thinking about, some of the other factors that then impact a property investment, you're probably not going to those areas either, because it's not the kind of it's not the kind of people, it's not the kind of performance, it's not the kind of attributes of a tenant that you're looking to have. So I actually don't think it's going to have too much of an impact on that side of the equation. But again, the big thing is sentiment, and I'm probably going to say it another half dozen times before we end. That's the problem with news headlines, is they can be a bit misleading, and the last thing we need is for sentiment to not understand that the people that are being impacted by it probably aren't the same group of people who are impacting performance of properties.
Yeah, and I try and keep across all this sort of stuff, and I'm not an expert at all, but I sort of hear or read the headlines, and everyone's been talking about immigration being one of the major drivers of shaping property prices, and particular rising rents. So they're saying, I can't rent where I want to rent because there's no places available because migrants are taking up all those places, right? And it depends how you choose.
It's pretty narrow-minded
to view that. What was interesting though, and some of the numbers I saw, and I'm probably going to butcher these numbers, but they're sort of thereabouts. 2+ million people in Australia are temporary.
Okay. Yeah.
Temporary.
Yeah.
10%. 10% of the Australian population are temporary. They're on temporary visas.
Yeah.
A lot of them are students, and where they have problems is that people come out on these temporary visas. They go and do a dodgy course to get a visa to be able to work. They work more than they should do under minimum wages, and they're saying that's an issue. Again, the problem you have though is that they're saying we've got unemployment at largely record lows. We can't find enough people to do the jobs we need to be doing. If we cut off certain aspects of the workers that deliver whatever needs to be delivered, we're going to have bigger problems. It's a massive issue for the government to try and grapple with, because on one side they've got vocal people saying we can't afford housing because of migration, and then if we don't have migrants, the economy is going to be slowed, stifled, particularly building and skilled labour. One of the issues is that people keep extending their visas forever, particularly master's students, right? And that's what they're going to try and get stuck into, which I'm okay with, right? But they don't want, they call them permanent temporary workers who are just here forever. And that's what they're going to have a crack at. I don't know in the areas where most of the people who are listening to this podcast, whether that will have an overt impact on the performance of their properties. Maybe these Alexandria, where you've got huge high rises of rental stock, maybe they might wane a little bit, but I think still to be played out.
Yeah, and I think the government has been very sneaky about the way that this has been marketed to people, because if so every month I do a full review of the RBA cash rate decision, right? So on our social media, I'll spend 5-6 minutes breaking down every page of it. Every paragraph of it. And one of the things that is abundantly clear, and it's been the same for the last pretty much 18 months, is that the one line that always remains the same is that service inflation, as in the inflation like goods and services, the inflation of services still remains higher than what they are looking for. Right? Goods have come down now. Goods have almost normalized to the point that the RBA is satisfied, but the service market inflation has not. And the government knows that we have a lack of pretty much everybody in all services, right? I've got a couple of mates who run an accounting firm. They were telling me they can't get accountants in to save themselves, right? Like they are actively turning clients away because they can't get accountants. Same thing in software development, IT, like literally every single area you can think of pretty much has a shortage, and the government knows that. So they're not going to stifle migration for the areas of demand because we can't deal with it as it is right now.
It'd be a huge handbrake on the economy.
Absolutely.
So to me, it feels like they've gone, yes, we're going to do something about this bit here.
Yeah.
They're trying to have their cake and eat it too, which is probably what I would be doing, right? Don't mess with it too much.
Yeah.
Like I think Australia needs to have a very mature view towards migration, and that is we're a nation of migrants.
Absolutely, we are, and migrants drive so much of what we do.
Yeah.
Migration is fantastic. I think the fact we're so multicultural is one of our biggest pros as a society, and that's not going to stop. And I think it's a very typical, like putting aside any political beliefs or not, it's a very typical political response to Band-Aid a solution, and that's what this to me. That's what this looks like.
And it's short-term policy decision making without really a long-term view, and you only need to be careful what you wish for, right? Because you only need to look at the decision that England made around Brexit. So a lot of people are scratching their heads there now going, well, maybe we shouldn't have done that because all of those people, which were pretty much the backbone of our economy, that did all the jobs that, inverted commas, English people didn't want to do, it's stifling the economy and things are going backwards, and it's not a great place to be right now.
Absolutely.
Australia, be careful what you wish for, because we need the migrants to do a lot of the jobs. When your mum's in aged care, guess who's probably looking after them?
Yeah. And I think there's something to be said, though. People want to be here, Like we've had our biggest year of migration ever, maybe. Or somebody can fact check me that, but one of our biggest ever.
I think it has been. Yeah.
Why is that? It's because people want to be here, and I would much rather have people here, contributing to the economy, contributing to our property market, doing all those great things, who want to be here, rather than the people who aren't contributing and who aren't helping and who are potentially, draining resources from one area of the economy from another area that's so much more needed. And to me, I think, like migration is phenomenal, right? It's phenomenal from a society point of view, but it's also phenomenal from a property point of view.
Yeah, and we've got a favourable listenership of property investors, right, who all want their properties to go up in value. But, to conclude this point around migration, if that's going to be the response, the government's now talking about this migration policy that they've inherited from the last government. This is just political stuff, right? If the government is going to tackle housing, this issue around housing affordability, by saying we're going to stop these little bits of migration, I'd be approaching it very differently. I'd be looking at housing affordability from a structural point of view, and that is making sure that we facilitate more housing. So we're behind where we need to be in what we're building, and a lot of reasons why is because, yes, you've had increases in materials, but labour shortages. So you want to stop migration to build the stuff that we need to build. Some very, very complicated and complex matters for the government to work out, but this inflationary pressure and interest rate environment, what do you think is going to happen? Inflation's softening.
It's getting massively.
There's nowhere near the...
No.
And there's an argument also where a lot of people are saying this 2 to 3% traditional band of this target rate that the RBA looks for is, some people are saying, well, it's irrelevant now, right? But it sounds as though they're still trying to push back to this target band of 2 to 3% inflation. Yeah. It is softening. It's sort of spiked. I think October numbers are up, and then they sort of shifted interest rates up. So it is softening, and it seems there is a downwards.
Yeah.
At a monthly level, I think it was negative last month, but it's still at an annualised level. It's a lot higher where they needed to be.
Yeah. So I think so they had some numbers that came out. It must have been end of November because it was just before the December decision, and it was we were down to 4.9% annualised inflation. Yeah. So that's obviously a far cry better than I think we ticked over 8 at the peak.
It went
I think
up.
it was 8 point something at the absolute peak. But it's really good to see that happening because it is making it difficult for a lot of people out there. It's we do need to see that softening. But I think more importantly, because of that and because interest rates on mortgages and the cash rate by extension is the lever of that, it is the biggest thing that can be pulled to try and curb spending. I am happy to call it and say we're at the end of the cycle, right? I'm not saying there's not one more or two more left, but we are at the end of that cycle where any more pain is going to be very much short-lived. And then over the next, probably 12 months, like I think I do think that by the end of next year we'll have seen at least a cash rate cut. If not an actual cash rate cut, some of the banks might have ended up having to turn around to say we're going to give everyone a little bit of a reprieve. We'll drop it by a small amount.
Yeah,
right?
Good luck.
Yeah, but no, I do think that the economy isn't. Realistically, the economy is not that healthy, right? Like it's not poor, but it's not that healthy. It's just artificially inflated because of the supply and demand pressures that all came about out of COVID. But at a granular level, like we are not, we don't. There's nothing wrong with our economy, but it's not like we're just an absolute powerhouse machine ticking along, doing all this stuff. And as this continues to normalize, that is then triggering a lot of this government response around a lot of different areas to go, we've got to make sure that we're not pushing it too far. So I think that's going to be fantastic to see, and ultimately it will flow to demand because if you've got 100 people who can borrow $1 million, and then suddenly we have a drop, and now it's 120 people can borrow $1 million. Well, that's now another 20 people competing over the same pool of properties. So we will inevitably see an increase in prices, especially since the supply side of property continues to be so constrained, right? Like latest data out of CoreLogic, we are still 20% lower in dwelling approvals compared to the 10-year average, right? 20% lower, and yet we're having record years of migration. So, how does that look, really? And then just a few other ones for the people out there who love numbers, right? Government announced that big plan of 1 million properties are going to get built over the next 5 years. We're already expected over 24 and 25 to be 30,000 homes short of where we need to be. And then by the time we get up to 2027, we're going to be 100,000 homes short of what we need from a housing needs point of view.
Despite those.
Well, that's because the government's not going to hit it for starters. But in terms of the planning around increasing population and things like that, the government's own housing body has said we're going to be 100,000 dwellings short of what we need to be, of which we're already short, right? But 100,000 on top of that by 2027.
See, and this is the issue, right? We're just kicking a can down the road. We're sort of stuck in this thing and saying, yes, we'll fix the housing crisis by stopping a certain element of migration. Like they've got to structurally, and I'm not saying it's a massive issue, right? And there's a lot of people who have a voice on this. It's very difficult for the government, but 100,000 property short. So you're stuffed. Like no matter what you do, you're stuffed. So where are all those people going to live? Like,
absolutely.
So what does that mean for those houses that do exist? There's going to be demand for them.
Absolutely.
Whether it's to rent or whether it's going to be for buying them. This is supply and demand. So for property investment and investors, it's a double-edged sword because you sit there and just go, if you are an investor in property, you will get some benefit from this, right? The other side of it is there's going to be, in many ways, stifle many of the opportunities that Australia has in this decade and this generation to emerge as a powerhouse of Asia, right? We're it's an attraction company. People want to come and live here. We want to grow the economy. If we can't house people, we can't achieve that. So we'll be a handbrake on the economy. So the government needs to be it's such a challenge ahead of them to work this out, and there's going to have to be some bold and ambitious decisions made around this.
That's some big words to use around Canberra. Bold and ambitious.
But it needs to be bold and ambitious,
I agree.
right? It needs to be bold and ambitious. Just doing what we've done up until this point ain't going to solve it.
No.
Ain't going to solve it.
But in good news for all those people out there who either are property investors or looking to be property investors, they're the ones who are going to reap the most benefit because there is a really small pool of properties and a really big pool of people who want them. So that is going to move the dial.
And this, therefore, also exacerbates the situation because, you need to have you need to be comfortable as a property investor that because of what you're doing, you're investing in property for the purpose of creating wealth, for the purpose of creating a better environment or giving you choices in time. So as a property investor, you need to be comfortable that you are getting the benefit of sometimes a mismanagement of policy at a government level, right? And by the way, the government incentivises you to do that through the tax system, right? They want the government doesn't want to own rental property. A third of Australians rent. The government don't want to own the stock of houses that renters rent. They don't want it. They want private investors to do that. So they incentivise you to do it. So you need to be comfortable. And I'm sort of sometimes have a level of discomfort around it, with a foot towards the social aspects of housing. And for those that know me well and they know my upbringing, you need to have a consciousness of the challenge that a lot of people have around this, right? So it really is a catch-22. It really is a catch-22 for investors. But if you're tuning into this, it means that you're trying to create wealth.
Absolutely.
Let me give you this. You're contributing as a property investor to putting people into rental property. So if anyone tells you you're a bad and evil landlord because you're creating wealth through providing rental stock, you're actually contributing to the nation.
Absolutely. And the University of Queensland recently did a study on this, and I'm 100% paraphrasing here, but effectively the result of it was that because of how governments all around the country, both federal and state-based, have everyone's selling off public housing, right? Public housing just hardly exists anymore. Because of that, if private investors withdraw from the market, it would effectively collapse the housing situation of Australia. So private investors are 100% providing a valuable service and need. And I think that it then just comes back down to there is a way that you can create wealth and still be a good person at the same time.
Yeah, and that's the point.
Exactly,
and it's okay.
Absolutely.
So be comfortable with it. Yeah, is what I'm getting. And it's a sentiment thing as much as anything. But you need to have a positive sentiment towards growth, and you need to understand and appreciate what property should deliver to you in time. And you said the average growth 30-year period was 7.25%, whatever it is. So what's your thesis then for price growth in 2024?
Yeah. Well, I'm very bullish, and and to me it's
is that everywhere or somewhere?
Oh, look, I think in a lot of places, I think that at the end of the day, the big drivers are supply and demand, right? And we've got massive demand, low supply, so that already puts places in a good position. I'd say that a lot of the more expensive type of markets, like that more premium end, they've had a lot of their drops, right? They've had that pullback out of COVID where they just went crazy. They've sort of normalized a little bit. So that premium end of the market, I think, is tipped to have a little bit of performance in there from that, again, that supply and demand aspect of it. But I think ultimately, especially that affordable end of the market, you've just got so many people competing that need homes, that want homes, like anywhere from probably like 350, 400 up to probably about 800 is a loose bracket I'd put on it. You've just got so many people who can afford it, who are competing over it, that makes up a very large portion of Australia. Like the eastern suburbs of Sydney and the pricing there is not reflective of what most of the country is like. So for me, it very much, it's very bullish, and it's the numbers, it's the supply, it's the demand, it's the fact we know credit is going to likely become a lot more accessible. Dwellings are not going to continue to improve on the approval side of it. Where we know we've got a shortage of properties. So to me, it's just an inevitability that we are going to be pushing forward. And I think that's really exciting for anyone who has property, because it's going to allow them to continue growing that portfolio. And for anyone who doesn't but is looking to jump in, it's a great, I would say, almost safety net, because the numbers all support it. And that's why we haven't really seen much of a dip, if anything at all, despite the fact we've had, almost 4% or over 4% added to the cash rate. And in turn, it's probably more around the 4 to 5% added to interest rates.
Yeah.
By any normal common sense, you'd say the property market would have had to have a really bad year. And yet it's maybe not been the exact opposite, but it's been a pretty solid year for a lot of people. I mean, our clients obviously reap that benefit with our performance, but even for the average Joe.
So Lachlan, you're telling me that 2024 should be a good year, and we've sort of dissected that in some way, and we've sort of, haven't gone into too much detail because we don't have the time to break down all those different areas like inflation, interest rates, sentiment, stock on market, supply equation, etc. We go some colour to it all. But considering what you've discussed and your position on this, and you look at the performance that you've been able to achieve for your clients up until this point, how do you prepare for success for 2024?
So I think the first and most important thing is you need to either review your existing portfolio plan, and if you don't have a portfolio plan, then I urge you to create one, or come and chat with us and we can make one for you. But if you don't have a plan, like the analogy I always give is you wouldn't start a business without a business plan, and yet you're probably going to take on more debt and contribute more capital to your property portfolio than you would starting a business. So yet everyone just jumps in without a plan, right? And for me, that's a big reason why I think 91% of people never move past having one or two properties in their portfolio, because they don't have a plan, they buy the wrong thing, or they buy a good thing but at the wrong time or the wrong stage of their portfolio, and they get handbraked. So the first step for me is review your portfolio plan or create one if you don't have it. And for most people, you're probably going to need help with that, right? So get that help, right? Whether it's us or somebody else, doesn't matter, but get that help to set yourself up for success. By having that plan, you're then going to be able to understand, A, what's the next purchase in your portfolio, whether it's your first one or your third or fourth or fifth or whatever. You can understand what your next purchase is. You're then going to be able to start to decide and take those steps on whether or not you've got the knowledge and the time to do that yourself, right? Do you have the time to go to the bank and get your own mortgage, or do you want a broker to do that for you? Yeah. Do you have the time or the knowledge to know where to invest and why to invest there and then go and do it? No, go see a buyer's agent, right? Financial advisors, accountants, all the same, right? You then are able to sit there and go, we've got a plan, we know what our next steps are. And then most importantly, go do something about it. Yeah. Take some action. Like I'm happy to say right now, December is probably the most annoying month from a business point of view for me, because I see so many investors who come to us who I know are going to sign on to work with us in January or February. And yet when we speak with them in December, their response is, oh, we'll just wait. We'll just put the can down the road.
Yeah, I'm worried about Christmas Day. I've got the family coming over. I can't,
Yeah, and the reason it's so annoying is because the people who are actually, they're serious, people who want to take action, people who actually want to try and grow their wealth properly, even just as something as small as in December, like right now, get your pre-approval done, get your portfolio plan done if you haven't got it, set yourself up so you know what you're doing. So come January 8, as apparently all businesses are coming back, come January 8, you're now ready to execute from day one. But the people who kick the can down the road and they go, all right, January 8, we'll now start thinking about it, suddenly they're not ready to go till Feb or maybe March. And then they're the same as everyone else. And now you're going to have that massive influx that happens in that first quarter of the year where a lot of people are fighting over it. And if you're doing it yourself, that becomes almost an impossible task to get a good property. But even using a buyer's agent, we have the numbers we have because we're not going to sacrifice our quality, but it's making it harder for yourself, So that's why, to me, the answer has always been, and I know you agree with this, Phil, the best time to invest was yesterday. So don't push it a month or 2 months or 3 months. Don't sit there and go, oh, I'll wait till after I do my tax return just because I can't think about anything else. If you don't have the time to do it, get the help. Because if you do, that 2 or 3 or 4 months that actually has you moving forward, imagine that compounding over 20 years. That's a lot.
It's crazy. If you get that upside, it's all about timing. And this comes back to the old adage of imperfect action always trumps perfect inaction.
Yeah.
So just get started, do something about it. So on that basis, then, you guys and girls are still operating up until Chrissy. They can, if people want to start, they can call you guys up and
absolutely.
Take their call.
I'd work over Christmas if I could get the damn lawyers to do property contracts for us if we were buying properties. But no, we're working all the way up. So if you're out there, you're thinking about taking action. Obviously, I've just given my thoughts on starting now. But whether it's now, whether it's January or February, whatever, come and have a chat with us. We can create those portfolio plans for you. We can set you up. For our clients having 20% average annualized capital growth since we started buying years and years and years ago, if that's the kind of numbers you want, we're your people. Come and have a chat. But otherwise, I'd just rather have people call us up and say, hey, we did it ourselves, but maybe listening to this made us take action. That would also be something great to hear.
That's good. It's surprising, and I've got to pinch myself sometime. How many people actually listen to this? And they go, you just don't know. These are all the quiet investors out there who we've been able to influence positively in some capacity through tuning into this podcast. And often we don't hear about it, but to all those quiet investors out there who have decided to take action from any information you've heard about this. And I'm a big proponent also of financial literacy. One of the reasons why I do this podcast, because I sit there and I just see the mistakes people make investing in property and go, it's not that hard. be very careful where you get your information from for shaping your decision making. So my job is to bring people into this podcast from all different aspects of property investment to talk about what they're doing and how they do it. Hopefully, can shape what you're doing about it. But Lachlan, well done, mate. What about Talvr? What's the address of that again?
Yeah. So Talvr, Talvr, that very techie name. So come over to Talvr, talvr.com.
I expect you to be wearing a black shirt with a white Talvr thing on it, like proper tech merch.
Yeah.
When are you going to hook us up with some of that?
Next time I'll come in t-shirt, the real techie jeans, all that. Yeah, we'll do
that's
that.
What you need.
But yeah, no. So come over to Talvr, Talvr. You can do it as .com or .com.au, but Talvr, and you'll be able to really start taking control of your portfolio performance. And then obviously as well, if you are looking to invest, come over to atlaspropertygroup.com.au. We'd love to have a chat. We'd love to help you out. But you've got to start that conversation with us. Yeah,
you've got to do it yourself. That's what it's all about. Take action. Thanks for tuning in, everyone. A couple of different chats with Lachlan Nishi. Go back and tune into it on the Property Investment Podcast Network, which you're probably tuning onto this. Hope you're all enjoying the break. If you're currently got time off work, but use the time effectively. You don't need to actually put pen to paper, but use it irrespective of what you're doing. Thinking about property, shape your direction. Now's the time to do it. Go and check out smartpropertyinvestment.com. There's heaps of information there. And Smart Property HQ is where you'll find us on social media. See you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.